The Fed kicking off its latest two-day policy meeting today. Central bankers widely expected to hold rates steady, but investors are going to be watching and listening closely for any hints about future rate moves and much more. Joining us right now is former Richmond Fed President Jeffrey Lacker. And Jeffrey, let's talk through what you think is going to be discussed at the table, what you would be talking about if you were there today.
Well, they have to be happy with the inflation numbers they got in June and July, although August wasn't as good as could have been. They've had moderating inflation expectations. They've had a labor market that's been cooling at a comfortably gradual pace. But at the same time, I think they have to be worried about whether June and July represented transitory good luck. The housing market has been firming for several months. I haven't looked at this morning's numbers yet, but it's been on an upward trend. Prices and starts putting pressure on resource utilization. There's a big pipeline of medical cost increases that are going to hit the CPI later this year, and that'll pass through to higher inflation numbers on the core side. And they've got to look at wage inflation being too high relative to 2% inflation rate. And so I think they're going to be worried that they might need to do more. They might need to keep up pressure. So I don't expect them to send any overt signal that they're done for this cycle. I don't see the upside in that for them. There were 12 dots above the current Fed funds rate last time. I think there'll be less this time. Some people have moved into the no further rate increase camp, but I suspect there'll be a number of dots above that. And I think Powell will try and leave the door open for further rate increases.
Would you be feeling pretty comfortable right now if you were at that table, though, just thinking that things are looking better? Or is that the time you start to worry about what could happen next, what's the next shoe to drop, whether there's issues in the credit market? And by the way, add to the list of things you were talking about being potentially inflationary. You've got the UAW on strike. What's that going to mean for auto prices, which had been a big component that have been coming down? And you've got oil prices moving up once again, too. And so gasoline had been another issue that had kind of been saving us on the inflation front, lower prices earlier this year.
I think you're right that the union wage settlements and oil prices represent upside inflation pressures risk. I'd also add to that the fiscal situation looks to add substantial pressure going forward as well. That's going to drive up what's called the neutral real interest rate. It's going to mean that a higher real rate is required to just remain as restrictive as they are. I think they got to be worried about those risks. Even if those aren't realized, they got to worry about the risk that inflation settles in around 3.5% or 4%, not incredibly close to their 2% objective. Wage gains build that in, and they're sort of stuck in a muddle at around 4% in the middle of next year, and they're going to need to keep up pressure.
We had a guest earlier today who suggested he thinks it's an 80% chance that you're going to see a government shutdown in the next couple of weeks. How would that change the picture potentially pretty rapidly?
Yeah, so the effect on the longer run fiscal imbalance, I think, would be the first order thing. The second order thing is that, when markets get jittery about a shutdown, the Fed tends to just pause action, but they're on pause right now at this meeting, at least anyway. So I don't see that having a big first order effect on that dimension.